Before you submit your next credit card application, stop right there. Because there are 5 critical mistakes that can get you automatically declined even if your credit score looks solid and your income seems fine on paper. I've helped thousands of people get approved for top tier business credit cards and see the same mistakes over and over again. And the good news is that they are completely preventable if you understand how to speak the bank's language. This isn't about TikTok hacks or shady loopholes. It's about knowing exactly what not to write so you never get that decline message again. So by the end of this video, you'll know exactly how to get approved for the cards that you actually want and not what you get robotically approved. So first one is the employment status trap. The first and the most common mistake is listing yourself as self-employed or retired on the applications. And here's why that's the problem. About 80% of the applications are handled by algorithm, not by humans. And those algorithms instantly flag self-employed or retired as high risk. So in the banking system, self-employed means unpredictable income and retired means fixed income, less flexibility to handle new debt. If you run your own business, you're not self-employed. You're still employed by your business. Even if you're a sole proprietorship, list your business name on the applications. And if you don't have one, create one. Something simple like Johnson Consulting or Smith Marketing Solutions. If you're retired but still earn income, list consulting, rental, or gig work. List that as your employer. The goal is to demonstrate ongoing stable income. That's what the algorithm wants to see. Second is the income misstep. Your income entry can make or break your approval or starting limit. Most people make one of the two mistakes. Either they underreport because they only count the take-home pay, or they inflate it unrealistically. Credit card application asks for gross income, not net income. That means before tax and deductions. If you make $70,000 last year, but you're on track to make $100,000 this year, you can list anywhere from $100,000 to $150,000 because you can reasonably expect to earn more and optimize your income. You can also include household income like a spouse or regular family support if you're over 21. And if you receive non-taxable income like VA disability, you can also increase that number by 25%. But don't go overboard. Claiming $250,000 while financing a $14,000 car for 7 years looks suspicious. So keep it realistic and consistent with your credit profile. The third biggest mistake is reporting rent. If you rent, pay attention to this one. This is huge. Unlike mortgages, rent isn't reported to your credit bureaus. So when a lender asks you for monthly housing payments, they only have your word for it. So here's where people mess up. They report the total rent instead of their own share. If your rent is $1,400 but you split with your roommates, only report your $700 share. Overstating your rental income makes it look like your expenses are higher than they are, and they're hurting your approval odds. Rule number 1. Here's the rule of thumb. Only include your portion of rent. And don't add utilities or maintenance into your rent reporting. And if you live rent-free with your family, list $0 as your rental income or list $0 as your rental payment. Keeping your housing cost realistic gives lenders a true picture of your finance and improves your odds of approval. Now, the fourth biggest mistake is business category red flag. If you're applying for business credit, this next part is very critical. Certain industries are automatically denied. Like for example, real estate investing, crypto, cannabis, gambling, any adult entertainment industry, or even credit repair. It's not personal, it's just compliance. These industries carry high financial risk and legal risk associated with running this business. Every business has a NAICS code, which is the industry classification code, which tells the banks exactly what you do. So if your field of work falls into high risk categories, emphasize the safer side of your work. For example, instead of real estate investor, you can say real estate consultant. You're not lying, you're just presenting your work in a way that the banks are comfortable lending you to. And the fifth biggest mistake is the credit report blind spots. This is the most preventable mistake people make. Applying for credit cards without checking your credit report, that's like walking into a job interview without knowing what's on your resume. Before you apply for any cards, pull all the 3 reports: TransUnion, Equifax, and Experian, and make sure that it's FICO 8 credit reports. Okay, which is what the banks and the lenders use to determine your eligibility for funding. So these are the things that you need to check for. You need to check for misspelling of your name, outdated address, old addresses or old accounts that has late payments, number of inquiries in the last 6 months, and fix those errors before you apply. These minor inconsistencies can trigger denials or manual reviews. If you need help cleaning up those inaccuracies, you can use tools like Credit Rehab Profile or Dispute B, which can make it a lot easier and faster to remove those inaccuracies from your credit report. Now, here's the bonus tip. Before you apply for anything, keep these things in mind. Every bank has its own rule. Like, for example, Chase's 524 rule, which means that you cannot open more than 5 accounts in 24-month period. If you open any more accounts than that, it is going to be automatically declined. Now, another rule is Capital One's limits rule, which limits how many credit cards you can hold at once. These are the rules that you need to keep in mind. Second tip is start with banks where you already have a relationship with. If you have a checking account with BOA or Chase, then apply with them first. They already know exactly how much money is being deposited, and you have long-standing established relationship with these banks. So they're more likely to get you approved for these business credit cards. And if you're rebuilding your credit, start with a secured credit card first. They're easier to get approved and helps you build positive payment history. Fourth bonus tip is use pre-qualification tool before you apply for any type of business or personal credit cards to see exactly how much you get eligible for without putting a hard inquiry on your credit report. Now, everything we've covered won't matter if you got serious negative items dragging down your credit, and those issues can cost you thousands in high interest rates and denied approvals. So if you're serious about fixing that credit, watch the next video where I show you how to remove these negative items automatically using AI. And if you like this video, stay tuned for the next video where I'm going to talk about how to get approved for $100,000 to $200,000 on business credit to use that to buy a business or even get into real estate utilizing 0% capital. So stay tuned and I'll see you in the next one.